Ms. Arabile Kumeto. Of course, we are eagerly anticipating the Reserve Bank's Monetary Policy Committee to announce its interest rates decision. They are widely expected to keep the repo rate on hold at 6.75%. The bank is expected to announce that rate any minute from now. We are, of course, taking a look at what the room looks like, and it does seem that we are still awaiting the governor and the Deputy Reserve Bank Governor. There are images live for you from the Reserve Bank, of course, out in Pretoria. My two guests a little bit later on, of course, will be joining me to unpack the decision as it comes out. Nikki Weimar from Nedbank joins us, and Gerald Mwandiambira, of course, the acting CEO of the South African Savings Institute. The governors have indeed stepped into the room. The MPC announcement will be made in just a moment or two. Of course, we will listen into this and we'll have more discussion for you right as things proceed. We'll head off now straight to Pretoria and get that decision for you live at 3 o'clock.
Good afternoon. Before we start, an apology from Dr. Rashad Kasim. He was part of the meeting, but he had to leave and attend a forum of chief economists at the Bank for International Settlements. So he was very much part of the meeting. Since the previous meeting of the Monetary Policy Committee, global growth concerns have increased, with particular weakness visible in some of our major trading partners. Domestically, electricity constraints combined with weakness in business and consumer confidence weigh on the forecast. While inflation continues to show near-term downside surprises, the medium-term outlook is impacted by higher energy tariffs and rising food and fuel prices. The year-on-year inflation rate, as measured by the Consumer Price Index for all urban areas, was 4.1% in February, up from 4.0% in January. Goods price inflation was 3.0%, while services price inflation remained at 5.2%. The bank's measure of core inflation, which excludes food, fuel, and electricity, was unchanged in February at 4.4% for the fourth consecutive month. Producer price inflation for final manufactured goods increased to 4.7% in February from 4.1% in January. The inflation forecast generated by the SABC quarterly projection model is broadly unchanged since the previous MPC. Headline inflation is expected to average 4.8% in 2019 before increasing to 5.3% in 2020 and moderating to 4.7% in 2021. Headline CPI inflation is expected to peak at 5.7% in the first quarter of 2020 and settle at 4.5% by the end of the forecast period. Previous MPC statements have highlighted the risks to the forecast presented by volatile oil prices and food price surprises. In light of recent developments, the assumptions for Brent crude oil in the QPM were revised up by $2 per barrel from $62 to $64 for 2019. The assumptions for 2020 and 2021 are unchanged at $65 per barrel. Fuel and levies announced in the 2019 budget have been included in the forecast. The turning point for food price inflation has also been difficult to predict due to lower than expected meat prices and weak demand. Food price inflation is expected to bottom out in the first quarter of 2019 and to peak at 5.9% in the second quarter of 2020. The forecast also takes into account the recent electricity tariff increases announced by the National Energy Regulator of South Africa. The assumption for electricity price inflation which takes into account municipal price adjustments, has increased from 12% to 13% for 2019/20 and from 6% to 9% in 2020/21. Higher food, fuel and electricity prices are expected to lift inflation over the medium term. However, this is expected to be offset by lower core inflation as unit labor costs and inflation expectations moderate. The forecast for core inflation is lower at 4.8 in 2019, 4.9 in 2020, and 4.5% in 2021. Average inflation expectations have been declining since the end of 2017. Inflation expectations, as reflected in the survey conducted by the Bureau for Economic Research in the first quarter of 2019, declined from 5.4% to 4.8% for 2019 and from 5.4% to 5.2% for 2020. Average five-year expectations also came down from 5.3% to 5.1%, which is the lowest level since they were first surveyed in 2011. The inflation expectations of market analysts in the March 2019 Reuters Econometer survey are also lower at 4.7% for 2019 and remained unchanged at 5.3% and 5.2% for 2020 and 2021 respectively. Expectations implicit in the break-even inflation rate remain sensitive to exchange rate movements. While still higher than the midpoint of the inflation target range at 4.97%, the five-year break-even rates are at their lowest level in 4 years. Although global growth conditions remain benign, the pace of growth is slower than previously anticipated. Business confidence has softened amidst increasing concerns about weaker trade and production, ongoing trade tensions and tariff hikes, as well as country-specific factors. Global GDP is expected to pick up over the medium term, but risks remain tilted to the downside. A further escalation of trade tensions, rising geopolitical risks, including the possibility of a no-deal Brexit and renewed tightening of financial conditions, could further weaken growth in an environment with limited policy space. A slower pace of monetary policy normalization is expected in advanced economies. Most of these economies are growing at levels close to or above their potential, while inflation remains below targeted levels. Inflation expectations are contained and in some instances lower than targeted inflation. Recent communication by the US Fed and the European Central Bank has signaled that their monetary policy stance will remain largely accommodative for now. Emerging market currencies have generally benefited from indications of continued accommodative monetary policy in advanced economies and low market volatility. Currencies of countries with stronger macroeconomic fundamentals are better placed to benefit from these developments. The rand has been affected by idiosyncratic factors such as domestic growth prospects, political developments, and policy settings. Since the January MPC, the rand has depreciated by 6.4% against the US dollar, by 5.2% against the euro, and by 6.1% on a trade-weighted basis. The implied starting point for the rand is 14 rands against the US dollar, compared with 14 rands 30 at the time of the previous meeting. At these levels, the QPM assesses the rand to be less undervalued. GDP increased by 1.4% in the fourth quarter of 2018, averaging 0.8% for the year. Fixed capital formation remains weak. This is largely due to declining investment by public corporations and government, as well as weaker business confidence, as suggested by the most recent RMB BER Business Confidence Index. The ABSA Purchasing Managers Index moderated from 4.9 index points in January to 46.2 index points in February, driven by a sharp decrease in business activity and new sales orders. The SABC Composite Leading Business Cycle Indicator has trended lower since February 2018 and contracted further by 1.8% in January. Household consumption expenditure has been stronger than forecast, but remains constrained by low employment growth, electricity price hikes, and higher petrol prices. Over the forecast period, growth in household expenditure is expected to decline to 1% in 2019 and 1.4% in 2020 before increasing to 1.8% in 2021. The SAP now expects GDP growth for 2019 to average 1.3%. The forecast for 2020 is 1.8%, rising to 2% for 2021. This results from the bigger than expected slowdown in the global economy, declines in business confidence index, potential supply side disruptions from load shedding, and growing pressure on household disposable income. The MPC assesses the risks to the growth forecast to continue to be on the downside. Electricity supply constraints and weak business confidence will likely limit near-term production and investment prospects. The committee remains of the view that current challenges facing the economy are primarily structural in nature. Given current economic vulnerabilities, prudent macroeconomic policies combined with structural reforms that raise potential growth and lower the cost structure of the economy have become even more urgent. The MPC takes note of the recent inflation outcomes and welcomes the moderation in inflation expectations. The overall risks to the inflation outlook are assessed to be more or less evenly balanced. Key upside risks are rising administered prices, including electricity and water tariffs, rising domestic food prices in the outer years, and higher international oil prices. Downside risks include lower global inflation and an extended period of monetary accommodation in advanced economies. Against this backdrop, the MPC unanimously decided to keep the repurchase rate unchanged at 6.75% per annum. The committee continues to assess the stance of monetary policy to be accommodative. Monetary policy actions will continue to focus on anchoring inflation expectations closer to the midpoint of the inflation target in the interest of balanced and sustainable growth. The MPC is of the view that there is little evidence of demand-side pressures in the economy. Over the medium term, cost push factors could arise from higher electricity, fuel, and food prices. The approach of the MPC is to focus on the possible second-round effects of the supply-side shocks. Any future policy adjustments will continue to be data-dependent. The implied path of policy rates generated by the quarterly projection model is for one hike of 25 basis points, reaching 7% by the end of 2019. The endogenous interest rate path is built into the growth and inflation forecast. As emphasized previously, the implied path remains a broad policy guide which could change in either direction from meeting to meeting in response to new developments and changing risks. That concludes our statement, and it's time for us to take questions. And as usual, if you could identify yourself and the media house that you represent, and the panel here will then deal with your questions. Yes, sir.
Good day, Governor, and good day to everyone on the team. Mfoneko from Reuters. Two questions, Governor. First question is, how significant is it that inflation expectations are starting to moderate? Do you see that as something that is temporary, or is it the beginning of a structural shift? And then a second question is, from the recent slide in the Turkish lira, do you foresee any sort of contagion impact or risk there? Thanks.
Thank you. Yes, ma'am.
Thank you, Governor. This is a forward-looking monetary policy question. You've taken a strong...
Your name,
Oh,
please.
sorry. It's Mariam Issa from Finweek. Thank you. Yeah, I have a forward-looking question. Governor, you've come out very strongly in defense of the current shareholding structure of the bank, and yet the President has recently said that nationalization must go ahead as in line with the wishes of the ANC. Are you at all concerned that this might undermine the independence of the bank, lead to a change in its mandate, or erode its credibility in financial markets? And secondly, under the circumstances, if you are asked, would you want to stay on as governor when your term ends this year? Thank you.
Yes, ma'am.
Governor, it's Pranesha Naidu from Bloomberg. I've got a couple of questions for you. Firstly, the appointment of a new deputy governor. Can you give us a timeline as to when that is expected? Also, how were your interactions with Moody's this week? And can you talk about the potential impact of a downgrade, either the outlook or the rating, on the current account as well as the banking system, please? Thank you.
Yes, ma'am.
I'm Khelang Bata from Bloomberg News. Governor, I see that the growth forecasts for over the forecast period have been downgraded quite substantially, or they've been downgraded at least. You state that this is partly due to a number of factors, but is load shedding a significant factor among those factors? How much have the recent power cuts and possibly future power cuts, how much do you envision that will strain growth?
Okay. Mfuneko, you would recall that at the time that we were introducing the quarterly projection model in publicly in November of 2017, we had indicated at the time that we would prefer that inflation expectations be anchored closer to the midpoint of the inflation target range. At the time when we mentioned this, the inflation expectations were bubbling at the upper end of the inflation target range. And it's actually been sticky over a period of time. Now, there are a number of things that could bring inflation expectations down. Theoretically, you would expect that price setters are rational and forward-looking in their price settings. But we also know that economic agents could actually be adaptive. What does that mean? It basically says that economic agents take yesterday's or today's inflation as the inflation they would see in the future, which means that inflation outcomes are as important for inflation expectations as what forecasts are actually spelling out to be, provided that the price setters are adaptive. In an environment where price setters are looking forward and are looking ahead of what is likely to happen in the future, and they are thus rational, it becomes easier for monetary policy effectiveness because everybody would be looking at the future. And as Miriam said earlier on, she was asking, she said she's a forward-looking monetary policy question. Well, we can't have a backward-looking monetary policy question. Monetary policy, by its nature, is actually forward-looking. And so, as we say in the statement, the recent decline in inflation expectations is a welcome development. And we would actually prefer to see the expectations declining further and getting anchored closer to the inflation target midpoint of 4.5%. As they are now, where they are at 5.1, 5.3, they are not yet at closer to the 4.5%. But the development is a welcome one. Is it a structural development? Too early to tell if this is a structural development. If it is indeed true and it is sustained that you will see a downward trend in inflation expectations, that will actually in itself have a future impact on the inflation outcomes. And remember, lower inflation is good for South Africans, and lower inflation is a key component of what long-term borrowing costs are, whether it is for the government, whether it is for the businesses, or whether it is for the individuals. So that is a welcome development. Turkish lira developments. I'm sure if you ask the governor of Turkey what he thinks about developments in the rand, he will say, go speak to the South African governor. But the previous episode of Turkish lira weaknesses did have an impact across other emerging market currencies. Similar developments seems to have taken place this time around, but not to the same extent as the previous one. The rand did react, but not as strongly as we saw in the previous episode of lira weakness. Why is it so? Our own reading is that market players are starting to distinguish between various countries and what the fundamentals of those countries are. And you are unlikely to see a general response in the manner that you had seen in the past episode of lira weakness. Prinesha, we had no interaction with Moody's this week. We had an interaction with Moody's the last time when they visited here. And like you, we are waiting to hear what they have to say tomorrow when they come out with a decision. What would the impact be on the, did you say the current account and the banking system? Well, much of the impact of any downgrade depends on how much the markets have already priced in. So to the extent that the market has priced in a possible downgrade, then if a downgrade takes place, it shouldn't have an impact on the financial markets. But you had asked on the current account deficit. So I guess then everything has been priced in. Nothing happens to the variables. However, if it has not been priced in and the downgrade takes place, it will come as a surprise to the market. That could spare selling off of South African assets. Bear in mind that should the downgrade take place, South Africa will be kicked out of the World Government Bond Index. And if that happens, it's expected that the holders of South African government bonds will then be forced to sell as they rebalance their portfolio because South Africa is no longer part of the government bond index. And if that happens, it is then likely to lead to an increase in borrowing costs. And I'm now talking of a scenario where this thing has not been discounted into the market. It would lead to a rise in borrowing costs in South Africa, one. And secondly, it could lead to a depreciation of the currency as the foreigners exit our bond market. And if that was to then happen, this is an interesting one, the depreciation of the currency. If the central bank manages to contain inflation from the depreciation of the currency, could actually be beneficial for the current account deficit. And it might actually be beneficial for exports. But that is provided inflation, second round effects from the depreciation of the currency are contained by the central bank. What would the impact be on the banking system? One of the financial stability reviews last year, or maybe the year before, 2016, did a stress test of the South African banking system to try and assess whether the South African banking system could withstand a possible downgrade. We modeled 3 scenarios. The other 2 scenarios are nice, so you don't have to worry about them. Let's talk about the ugly scenario, which is the most adverse of the scenario. Under the most adverse of the scenarios, it's expected that such a downgrade could lead to a protracted decline in GDP and lead to a situation where you have got an L-shaped kind of decline, which means that the GDP declines and stays at the bottom for a long time before it starts to recover, that the currency would depreciate, and because the currency has depreciated, you have a rise in inflation, second round effects kick in, so you have got a combination of recessionary conditions and rising inflation. And add to that, rising borrowing costs for both the government and for South Africans, which also feed themselves through into growth. Even in that adverse scenario, the South African banking sector came out with flying colors and was able to withstand such a scenario. So we are not worried about the impact on the South African banking sector as a result of that downgrade.
Well, that is, of course, the meeting there happening, of course, in Pretoria there with the Reserve Bank governor and the MPC then deciding indeed to hold interest rates at 6.75%. That's for the repo rate as well then. It is a unanimous decision there set forth by the Monetary Policy Committee, and we will, of course, unpack it. Of course, I do have 2 guests in studio.